Silver, for whatever reason, back in the 70s, just went up much higher in a percentage terms than gold did. Mm-hmm. And then they kind of were equal in 2010 to 12, but then we could see gold has outperformed silver.
So this chart struck me as really interesting, Steve. And I wanted to, I have a question on it, but why don't you walk us through why you wanted to include this one as well?
I just want to give a frame of reference because people say, well, I do think silver is underperforming gold. And we can clearly see, if you look at this chart, silver is in blue. It really went above gold in relative terms in the 1980s. So when someone says, well, if you look at the silver price on the top, and it looks like a cup and handle formation, right? Mm-hmm. So someone says, well, we got to complete the cup and handles. Like the handle has got to go back up to complete the cup and handle. Mm-hmm. Well, kind of the movement of silver was based on the price of energy. Mm-hmm. It wasn't because of the infamous cup and handle has to be completed. Now, it probably will, but the cup and handle came due to the price of energy impacting the value, the cost to produce these metals. Silver, for whatever reason, back in the 70s, just went up much higher in a percentage terms than gold did. Mm-hmm. And then they kind of were equal in 2010 to 12, but then we could see gold has outperformed silver. But one of the things we have to understand, if we go back to 1970, we see the gold cost was about $40. It's now $13.50. Mm-hmm. Silver, it was $1.50. It's now about $18. And these are my estimates. I'm going to do an update at the end of the year. But if you look at the lower part of the chart, the cost to produce gold has gone up 3,275%. That's what it costs. So I don't care how many people want to buy and sell gold. If I want to buy gold and there's supply and demand, it's balanced. Well, I got to pay what it costs to produce it. And then there's a lot more demand now for whatever reason. So it cost 3,275% more to produce gold, but it only cost 1,100% more to produce silver. And so these are dynamics that the quants and the rocket scientists that were hired from college by the financial industry because they can make a lot of money. These guys design all these algorithms, and they're very intelligent people. So they I think they know this stuff. They go, well, why should gold go to 2,500? Yeah, yes, there is a lot of debt. There's more debt. There's all these things going on. I get that. And that's true. But if we just look at what it costs to produce gold, these guys have figured out, well, there's these big margins right now. And let's say they don't know about the energy cliff. They're going to go by this analysis. So when you hear JP Morgan's analysts come out and say, we're going to see gold moderate down by the end of 2022 to 1,550, we could say, oh, there we go again. JP Morgan, the big manipulators, they're coming out, they're bearish, they're the big bank. But if we just can't give some reasoning, with the margins being so high, it's not impossible to see these margins contract because they have in the past. Mm-hmm. I'm not saying it can, but there is some method to why these banks are putting out this, because if the banks believe we're going to have a slower economy, the inflation is going to subside. I'm not saying it will. I believe it will. But if it does subside, then we're going to see a different dynamic. So that's the reason why right now, if we look at the cost to produce silver, there's a 27% margin. And if at 1,350 gold, there's a 35% margin. Those are good margins because just a few years ago, the gold miners they weren't making a lot of money. Mm-hmm. And they are. And so just looking at this dynamic only and the way the market, I call it just-in-time inventory price mechanism, because that's the way the mechanism of the futures markets works when you're talking about consumables. But again, right. Gold and silver are not just consumables. They're also money and a store of wealth. So that's a different dynamic too.
Mm-hmm. So Steve, when I first looked at this chart this morning here, it really struck me that silver has basically broken away its correlation to the gold price since about 2013. So I was wondering if you had any idea why that would be.
Two reasons. I think the reason for that had to do more with the inflation scare in 2011, 10 and 11, similar was to the 70s. And because the oil price had gone up so much. So even the banks you see, and I think a lot of the movement is the institutions and banks moving in. Because they have to hedge their bets, and they have to, who knows where things are going to go. But I think the underperformance of silver has to do also with the crypto market, has siphoned away a lot of interest in the metals, has siphoned away some interest in the metals. And, Max Kaiser used to be a big believer in silver. Well, he's forgotten silver now.
Yeah.
He's totally forgotten silver. And so now when you move these billions and it is billions away from the precious metals into cryptos, it has impacted silver more. But I actually think that's a good thing if you're going to be a silver investor, because there's not that much more silver than there's gold in the world as an investment. And that's another interview on its own. And so, but still, if you look at the margins, they're not that much different with the gold and silver margins. They're off a little bit. Mm-hmm. And I think maybe this is the dynamics of the algorithms doing this. But when we start to reach this energy cliff, these dynamics are going to matter less. And that's why the metals are going to shine, due to they're becoming a store of wealth that the market, the psychology of the market has totally forgotten about.
Yeah, it's also interesting to think about, that maybe at different points in history, there are some possible different drivers, but it's really important, or drivers for the metals prices, but it's really important to remember the energy side of the equation and how that drives the price, right?
Yeah, and if you look at the silver price, you see it bottoms about 14 twice in 2015, and then it fell there during the pandemic shutdown. Well, 14, that was about the break even. Mm-hmm. We didn't see it go down to 6. You see, people are telling me, well, Steve, it costs $5 to produce silver because that's what it cost Hecla back in 2000. Mm-hmm. Hecla's not producing silver at $5 an ounce, even though they show their cash cost very low, mm-hmm. because they have so many byproduct credits that lower their cash cost. But if you look at Hecla as a mining company and what its profits are, it's not producing silver at $5 an ounce. Mm-hmm. And no, it would be losing money hand over fist. So the mining industry now, that's kind of a good understanding. That's the reason why I kind of bounced off 14. The demand, for whatever reason, the demand for silver in the market, we could say manipulation by JP Morgan, or investors just could care less about silver for that period of time, but it did not really go below the minimum what it costs to produce it. Do you know why? Because savvy financial guys running these algorithms at these banks would say, you got to buy now, because now the mining industry is losing money, and we could hedge that because it's costing more to produce silver than they're getting it. So we're going to buy that silver. Mm-hmm. And that's what a smart person, a smart financial guy would do. So that's the reason why you're not seeing the prices fall below the cost to produce things, because that's a deal of a lifetime.
And that was something that I was thinking about as well when you were explaining that, is the byproduct production of silver and how that plays into the actual cost and price rise of the cost of producing it.
It is true. About 70% of silver comes from base metal mining, which is mostly zinc and lead, and then copper, and then gold. The 13% is a byproduct of producing gold. Most of it is zinc and lead. But here's the thing. Those mining companies may use silver to supplement its balance sheet. But people say, well, they're producing it for free, so they could just give it away. No one gives away that. They use that to balance, to supplement their balance sheet. So we have to understand that the base metal miners, the copper miners, also have a minimum cost of production. And if they're producing some silver as a byproduct, they're going to use that to fortify their balance sheet. That's additional revenues. Mm-hmm. If you take that revenue away, they may be losing money. So we have to understand that's the way the mining industry works as well. And so, but 30% comes from primary silver mining. Mm-hmm. So if it fell below that $18, then a lot of that 30% becomes unprofitable. Mm-hmm. And if it's unprofitable for an extended period, then mines shut down.
Right.
Now, what I want to show with this is it's a Chandler levels. These are called different levels. And all I want to show is there are cycle highs and lows for gold. Mm-hmm. And it's basically kind of just a feel. And what I want to show is when the price of gold shot up and the high of the cycle high is its peak. And then it came down in 82, went back up, hit that midpoint on the dotted line in 82, and then it came down and hit the low, the cycle low. And then you could see it bounces off due to various reasons, supply and demand and cost factors. But then we could see in 2011, it hit a high, 1900. And by gosh, 5 years later, it hit its cycle low. The same thing it did from 1980 to 1985. It did that from 2011 to 2016. But we have to remember these cycles didn't happen because of goat entrails. The underlying energy price had declined as well. And sentiment, market sentiment, for whatever reason, the gold price fell. And this big decline here in the gold price in 2013, that was a lot of that was net outflows of the ETFs. And I just did an update on that. If we look at the inflows and outflows of gold ETFs, that has been kind of one of the drivers of the gold price. Mm-hmm. And I think it's going to continue to be a driver, and it's going to be even much better. We're going to see much big moves in the ETFs, silver and gold, due to institutions which drive the market moving into the metals. And where do they do that, Tom? They're not going to call up my local dealer and ask for $1 billion worth of Silver Eagles, because there isn't $1 billion worth of Silver Eagles. Mm-hmm. They're going to go on the ETFs and access silver and gold that way, because that's where they do that. And so this is the dynamic we're going to see. But now we hit another cycle high in 2020. And so does this suggest, in 5 years, we're going to hit the cycle low? I don't believe so. But I think there's a good chance we're going to hit that median dotted line of 16, 17, especially if we get a slower economy, lower inflation, lower prices. We're going to retest that. But as these energy dynamics continue to become more volatile, as we reach the energy cliff and go over by 2025, the demand for gold and silver are going to change, because there's going to be a lot of problems with the asset values of stocks, bonds, real estate. And I believe these financial guys and the market is going to start figuring that out. And that's what's going to be the main driver of the price, not the cost to produce them.